The big wins come from being strategic. They don't know anything that is going on outside. 12 hours a day, they're executing, they go home and sleep. Investments that just go very smoothly, peacefully through that process, a lot of times they ended up not being good investments. Like I would say 90% of the time, I've never seen a large company sell a small company's product. Why are you telling me to use this software? Are you going to buy this company? Coming to the best companies, they always invest in actually people. Over the years, I have moved more from, does this company have a good product, to does this company have a good JD? One of the biggest challenges with institutional, what I've seen is a lot of time founders, they think that, hey, he's an investor, read some papers, read some blogs, what value she can bring. A good investor will say, hey, this has not worked in the past, but let's just think about it. A failing company or company that did not do well is not a signal for us. So no two corporate investors are the same. These guys are just running business. They can say whatever they want. Sometimes they like the company, sometimes they don't like the company.
A couple of years ago, maybe AI may not have been a big mandate for a corporate VC fund, but
entrepreneur walks in, comes up with a big, really good business plan. Guess what? You never thought about it, you have to write a check. The thesis here is ARR, not IRR. The best executive that you see in a corporate are heads down. The large enterprises will never buy because you have the right product. They'll always buy because they have a need. Spend hours and hours sitting in the CEO office and educating them. When you do an investment, it's think of it like a first date actually. A lot of people think that you're married, and I actually scared away a founder from starting a company. Okay. So on theory, everything looked really, really good, and I did some diligence and also looked really, really good. And they came back and said, don't invest. Product is not a company. One other thing that I keep telling one of the founder, and I really I said, give the product for free.
Hi there everybody, and welcome back to yet another episode here on the Desi VC podcast. I'm your host Akash Bhat, and this is a show where I bring you leading investors and founders investing and building world-class organizations between the US-India corridor. Well, joining me on the show today is a very special guest. Some of you may know him as the guy who posts funny, witty posts on LinkedIn about security, AI, ML, dev tools. But I happen to know him in his capacity as a lead investor in my own company, Lean. Joining me is none other than Pramod Gosavi. He's a senior principal at Blumberg Capital, a VC fund that invests between the Israel-US corridor. Well, Pramod has spent a good chunk of his time both on the corporate venture capital side as well as institutional venture capital. So today on the show, we're going to talk to him about the key differences and similarities between the both, and most importantly, the learnings that he cited being on both sides of the table. Pramod graduated from IIT Bombay and then later spent his educational years at Purdue and Wharton School of Business before embarking a career on the enterprise side as an engineer and later as an investor. At VMware, which is the corporate venture capital where he spent some time, he invested in companies like Armis, Affirmed Networks, and JFrog. All of these companies have either been acquired or have gone public. So prior to Blumberg, Pramod spent some time at 11.2 Capital, which is today known as Canach Capital, where he led investments in companies like MightyMeld, Collinear AI, Cybersecurity, and Lean, of course. I had a blast speaking to Pramod over the course of this episode, and we've uncovered a dearth of insights into what really goes into being a successful investor and working closely with portfolio companies both on the corporate venture capital side as well as traditional institutional venture capital. So let's head in and listen to my conversation with Pramod. Pramod, welcome to the Desi VC podcast. It's an honor to have you here. We've been in business for the last 2 years, and It's really a pleasure to sit across the table from you and actually uncover all the things that you've learned over the course of your career, but more specifically as an investor today. So on that note, welcome to the show, and how are you doing?
Thanks for having me.
There were a number of ways that we could have kicked off this episode, but when I was sitting and doing a little bit of research, I don't want to do the traditional, how did you land up in venture kind of a question, and that's out there for people to research and find out. What is more interesting is that you've spent time both as a corporate investor as well as a classic traditional venture capitalist. Speaking from that perspective, I want to take you down two different paths. One, what are the similarities that you found being an investor on both perspectives? And then perhaps on the other side, we can talk about the differences of being an investor with a CVC as well as a traditional venture firm.
Yeah, sure. So first of all, thanks for having me. I've seen a bunch of your podcasts, really good stuff. Yes, I would say the similarities between CVC and a institutional venture capital is one thing is common is you need to invest in companies that are successful. So, and it actually is more important on the CVC side. So it's a nuance that a lot of people don't get. It is on the institutional side, you're placing some bets, and if a company dies, it's not successful, you just lose your 1x, right? Like the financial investment. But on the corporate side, you actually are investing, both for financial, but more importantly for a strategic reason. And we always had this thing, my boss, Shaker, he always used to say that, look, if the company is not successful, the strategic outcome actually is not accomplished, because a failing company, a company that did not do well, is not a signal for us, right? So within the space is very important. So my thesis, my approach when I was in CVC was quite different than what I'm doing at institutional venture capital, because there you could actually wait, you could even miss a couple of rounds, but you have to make sure that you invest in a company that will be successful, because that's the value that it brings to the corporate. The differences, again, I think the financial gain is very different, and I had to reset a bit coming from a corporate venture capital to a financial side. Is you on the corporate side, we would invest in something that is really good technology and would be decently successful. But when you come on the institutional side, it has to be wildly successful, right? So and then you have to pick and choose also, because when you're on the corporate side, you have your guardrails, you have your fences around you where you want to invest, versus institutional, it's a free range, right? So then you have to pick and choose. And the way you pick and choose is like purely based on financial returns. So there have been times where, we passed on companies that looked really, really good, but hey, we need to focus on something that can get us a 100x return versus a 10x return, right? So I'll just pause here and see if you have any questions.
Yeah, no, there are a couple of interesting points that you mentioned there. And the appetite to invest for a corporate venture capital firm is obviously very different. Some of them are investing out of their balance sheets. It may not be a financial return, more for a strategic return. But what goes into making an investment there? Because you said it's okay to lose out on a couple of investments as long as you're getting them at the right point, where it still seems a strategic addition to the parent company. What goes into investing, or what goes into the thought process behind investing when you're perhaps missing out on maybe the first 2 or 3 rounds of that company?
Yeah, so first of all, so no two corporate investors are the same. I would say there are like roughly 2 or 3 flavors of corporate venture capital. One of them at a very far end is purely based on business, right? Like Capital One is a very good example. They only invest in companies that they become customers. They invested in Snowflake, they benefited from that, but they only invest in companies that they will eventually become customers, right? On the extreme end is we actually, like I myself would go to the business unit and say, hey, if you're already a customer, if you already have a business unit, there's no point in us investing unless you want to capture the upside, right? At that point, it becomes more of a financial investment. It's no longer a strategic investment, right? You already have a business relationship, right? So my comfort factor there was, yes, if the company is really good and you think that we can capture an upside on a financial side, let's just invest for a business relationship. But other than that, let's just invest for information's sake, right? Like, hey, these are some of the areas that you want to explore. Let's invest in some of the best companies and see how they're doing. So it's a purely strategic information gathering strategy there. And then there's somewhere in between where it's a combination of both. I would say, like Cisco is a good example where they keep on going between back and forth, like purely financial, purely strategic, and right now we're there. I'll say like in the middle. A lot of telco investments are like that, where I think they're in the middle, where they're trying to get some financial gain as well as support the business. So let me just come back to the original question: is what goes behind the decision making, right? So it all depends on how also the CVC is run. So a lot of CVC, there's a compensation problem in CVC where you don't have a carry. Like a lot of firms don't have a carry. You're more or less like an employee given some shares, right? So there's a motivation factor And it depends on how motivated that corporate investor is, right? If the corporate investor is acting like a professional VC, but sometimes they're not getting paid for that, right? So depending on how motivated they are, they might be actually going out and seeking companies, right? And we used to do a lot of that at VMware. Is to all of us were actually acting like professional VCs, getting a lot of deals, and bringing a lot of new companies that our business units would just not think about, and then exposing them and saying, "Hey, should we do an investment here?" Right. So that is one extreme where you are more or less functioning as a VC out there, going outbound. Then on an extreme case, there's an inbound, right? So, like for example, NVIDIA is a good example. Somebody, AI company wants access to NVIDIA chips. They come in and say, "Hey, we want access to the technology." So that's more of an inbound motion, right? So now that we have discussed like the outbound versus inbound, right? I think the next stage again, it varies from companies to companies. Is how do you pick companies and how do you actually get approved? Unfortunately, on the CVC side, there's always a sponsorship element, right? So the sponsorship can be a business unit. The sponsorship could be a CEO, right? And you have to figure out what gets done. So when I was at VMware, like 5-6 years, that was always a tussle as is like I'm getting a lot of deal flow from this end, and what gets done on the other end. And sometimes you can't predict because these guys are just running business. They can say whatever they want. Sometimes they like the company, sometimes they don't like the company, and they mostly don't make rational decisions. So a lot of times, as I spend more time at VMware, I started going higher up the ladder. I would just go to the CEO first because the CEO has no conflicts, and then drive investment from there versus going to a VP of product. Yeah, so I'll just take a pause here.
Yeah, no, you made, again, a couple of interesting points that I want to double tap into. Now, with a traditional VC fund, institutional VC fund, there's always a thesis that kind of that drives some of the investments, or at least that's usually how most VC funds operate. But on the corporate venture capital side, you mentioned that some of it may be financial, some of it may be strategic. And if it is strategic, the business goals and outcomes are constantly evolving.
Yeah.
And a couple of years ago, maybe AI may not have been a big mandate for a corporate VC fund, but today it probably is table stakes for everybody looking into it. So from an investment thesis perspective, how does it differ from a traditional venture capital in terms of the mandate that goes in to what companies to bring into the firm?
Yeah, so again, it varies from company to company. We actually had a pretty systematic process because, when I was there, CEO Pat Gelsinger, he used to run Intel Capital, and then he ran EMC Ventures. So he knew how to run it. So every year, actually, beginning of the year, we would actually come up with areas that we want to invest in. And a lot of those areas would actually be like a Horizon 1, Horizon 2 from the existing areas. And we'll also do a good job of talking to the GMs. Hey, what are you building this year? What is something on the roadmap? So we'll gather all of the information, and they will come up with broad areas saying that, hey, these are some things that are not being looked at. But having said that, we are not sticking to those because if you see something that is someone is just building something totally different that we didn't even think of, we will still bring them on. I think long term, I think that ends up being the best process is to have a strategy, because what happens is what you don't want is every investment one-off, like what's the process? Why are we doing this? So I'm a big fan of like beginning of the year, just say, hey, these are things that we're going to look at those. And then the approval is very easy. Like, you'll say that, hey, this investment fits in this particular thesis. We talked about it. This is what we are doing. And then the process is much easier. So just to sum it up, I think on the corporate side, having a thesis is much more important compared to the institutional side. Like institutional side, I think everybody has a thesis, but again, some entrepreneur walks in, comes up with a big, really good business plan. Guess what? Like you never thought about it. You have to write a check.
And how much of that split between the investment thesis on the CVC side is driven by the existing business versus where the business wants to be 5 years from now?
Yeah, so that's one of the difference that I talked about before is how tightly are you linked with business versus how loose you are, right? So if you say that, hey, I want to do investments only in a company that I can do business with, right, as a customer or as a partner. And I was actually interviewing with one CVC, and I did not end up taking the job. But the guy said the thesis here is ARR, not IRR, right? So he said we have to drive ARR of the company, not IRR. This is not a financial thing. So then I said, okay, that's not for me, right? Because I would ideally want a combination of ARR and IRR, but he said, no, the focus here is ARR, right? So I would say like both the models are successful. Like Capital One, like as mentioned, is a good example where they've invested in companies like Snowflake, where they use their business positioning to their strength, and they invested. Like Salesforce was a very good example. Also, they're widely successful. They used their position in SaaS, and they invested in a bunch of successful companies, right? So that could also be successful. I would say long term, if you look at like dollar for dollar and less risk, I would say that makes a lot of money if done right. Right. So that's also where people lose money, because, like I said, you don't need to invest in everything that you're doing business with. Sometimes, So if you do a good job of finding the best company that you want to do business with, and then I think that thing works well, right? On the other extreme, when you're doing it for information, when you're doing it for driving the strategy, that actually tends to be very, I would say, unpredictable, right? So a good example is like we at VMware, we invested in this company called JFrog, right? Had no synergies with us, very different business. We tried doing business with the company like 2-3 times, but we could never get anything going. And then ended up becoming an IPO, right? So I would say like the big wins come from doing strategic, but also you might lose a lot because you're taking a risk there. Here I would say it's like more predictable cash on cash basis, where if you do a good job of choosing the best companies within the pool, then you'll do well.
That's great. Now, a lot of our listeners probably are trying to understand the difference between CVC and a traditional venture firm for the first time. And we've kind of like given a very high level introduction to that. Perhaps we can spend a little bit of time, maybe the next 5-10 minutes, on getting into the weeds of, corporate venture capital firm. Let's talk about the decision-making process in comparison with a traditional VC fund. So say you bring a deal in, you're obviously doing diligence in the company. How does the next level of decision-making take place within a CVC? Is it traditional, comparatively, where you have an IC and you have, people on the IC taking a call on that investment? Or is it a different structure where it perhaps has to go to the board in some cases, where the board needs to approve it, especially if it's a larger check that's kind of being written? So give us a perspective on what happens at an early stage investment from a CVC perspective, as well as maybe a larger check that's kind of written by the big guys who put in maybe the $200 million checks and so on and so forth.
Yeah, I will start like one stage earlier. Like let's just say I bring in a deal, I introduce them to business units. Like I said, I think the concept of sponsorship is very important there. Like somebody from the business unit has to say that this is a good investment, and you need to find the right business unit sponsors, right? So I had my favorite ones. I mean, some of them are like, and in the corporate, you see many different kinds of executives, right? I would say like the best executive that you see in a corporate are heads down. They don't know anything that is going on outside. They just like literally 12 hours a day, they're executing, they go home and sleep, right? So there are times that I would go talk to an executive like that, and wouldn't know about any hot companies out there, like doesn't even know anything. But again, is that a bad executive? It's not. Like, he or she is doing the best.
Good at their job.
Their job, right? So first you have to find a sponsor, and then there's an investment committee. So there's that's where I think when the rubber meets the road, that's where like a lot of things fall apart or do well, right? I would say the investments that just go very smoothly, peacefully through that process, a lot of time they ended up not being good investments, right? Because it's like whenever you have everybody agreeing to it. Like I'll give you an example. So our security team was looking for a partner, right? And they had 5 different partners to choose from. They talked to the first 3, and the first 3 said, "Hey, I'm doing really well. Why do I need you?" So they stopped working with them, and then they went to number 4. Number 4 was somewhere like, "Hey, I could use your help," right? So, and they said, "Okay, we'll do a partnership." And the business unit guy said, "Okay, we will sponsor this deal. We'll go pound the table and get it done. You don't have to worry about it." And that's what happened. Like, so the investment went through like a breeze. And it got done, but again, it was like a number 4, number 5 player, right? So that's where I think the best investments are not going to be easy, right? Like a couple of the investments I've done where a lot of debate, like, is this the right company? Is this the right space? Should we play there? And it takes a lot of coaching and education on the corporate side, actually. And sometimes some people think that's a headache, and that's why a lot of people actually move on the institutional side. Right. So literally, I used to spend hours and hours sitting in the CEO office and educating them. What is the space? What is going on? But that's also the right investments to do as a corporate, because the minute you're bringing in new information and you're educating your executives, that's definitely a value right there, whether you invest or not, right? So, and sometimes I think that the process is not predictable. Like I have had deals where, everything looked good, everything was set up, and then something went wrong in that half an hour ICM, and then it didn't go through. It's kind of unfortunate. So I think there's a little bit unpredictability on the approval side. And you talked about small deals and large deals. So the large deals actually tend to be a little bit easy. So anytime we had done like a large deal, like a $10 million, $20 million deal, so they tend to be very strategic. You have like the CEO actually backing it up, right? All the small deals are like business units backing it up. Whatever it's a large deal, it's a CEO backing it up. So it's easy to go to the board and get it approved.
Because your champion there is going to be the CEO. Or she is going to be your sponsor at that point of time.
Yeah.
And how much of a say does a sponsor have when you're having those discussions from an IC level? Maybe not using the CEO as an example here, but maybe for the smaller deals, what's a good split? Like how much do both the IC members as well as the sponsor need to be on the same page for an investment to go through?
It matters a lot. So every time we had like a very strong sponsorship where the GM said, "Okay, I'll go pound the table and I will make it happen." Like a good example is one of my favorite GM, right? He went and proposed, "Hey, we should do this investment," and there was a lot of pushback from all of the other executives. Like the CFO said, "Hey, but you said, so the CFO says, like, how much is this going to help your business? Like, how much new ARR can you bring in, right? The CEO says, "Hey, you already signed up for like 10 different things and looks like you have to spend some time here. Is it worth your time?" The go-to-market guy is just like, "I don't even know what this company is like. We cannot help out," right? So there was a bunch of these disagreements. So it does take some pounding from the GM to go and say, "Hey, look, I'll make it successful." Right. And that's where I think having a strong sponsor is very important. So I think some of the best investments were really something that is very novel, that really excites all of the investment committee, saying, "Hey, this is very novel," like, or there's a very good founder that we need to be associated with. I think those investments didn't require like a majority. Like it happens at a different level, right? So, but anytime it comes to the thesis and the product and the market, that's where I think people disagree quite a bit.
Okay, now let's say everybody has approved an investment and the funds have been wired in. What's the value add that a CVC brings to the table for an early stage startup versus maybe a later stage company that's probably looking at it more from a strategic and maybe a buyout at some point of time into the future. But let's talk about that arc. An early stage company, why would it want to take capital from CVC, and what immediate value can be extracted?
Yeah, I would say like the best value is as a customer. I think that's like an immediate value that you see, right?
But do they become a customer before they take the investment, or do they become a customer after the investment?
So it's always good to do before, after, because again, you don't know whether it's going to happen. A lot of times you see CVCs going and say, hey, we'll become a customer, let's get the investment done, right? I think getting through that process, and I think that's always helpful. So the customer thing always is a no-brainer, and it's a value. Particularly like early stage, you want an enterprise customer, right? The technology partnership is always been nuanced, right? Because you're early stage, the company says, hey, why should I integrate with you? So we used to give them help in terms of putting them in front of a product manager, helping them understand the product and everything, right? Then if you take that even further, so a lot of startup founders, they go to corporate and say, hey, they're going to sell my product. They're going to get me ARR. And I keep telling them that's just not going to happen at all. Like I would say, I have never seen, like I would say 90% of the time, I've never seen a large company sell a small company's product. Like I was there on the other side, right? Like so I keep telling founders, like, look, there's so much risk for the company to go through to create a reseller solution or like even packaging, right? Yeah. And you might die next year. Like who's going to take the risk on the other side, right? So early stage, I would say like seed A going to be, it's not a good fit at all. Like I would not spend time at all. And there's other ways to benefit from it. Like for example, customer is a good one. The second one is if you form a relationship with an executive and that executive is coaching you, and we had like one of the executives joining the board and he helped the company quite a bit being on the board, or you can get some marketing, like going to their sales kickoffs and all. I would say those are like much better compared to, but most founders, they say, like there was a company that kept on saying, hey, look, you're not doing an investment unless you do a resell. I'm like, you're a seed stage company, like, we're going to kill you, but we'll do something down the road. Let's just figure out everything thing, right? But they're like, no, I want a reseller relationship right now, and that's just like unreasonable, right? So I would say, and then there are some CVCs, like Intel Capital is a good example. They expose you to their customers, right? But in case of Intel, it's very different that they invest in like software companies, they're hardware companies. So there's really no conflict there at all because Intel is never going to build software, right? And the customers want complementary software. So for them, I think it's very straightforward. But even if you look at Cisco or when I was at VMware, anytime we introduced our customers to the software, we actually indirectly create a dependency because they are like, hey, you're telling me to use this software. Why are you telling me to use this software? Are you going to buy this company? Are you going to provide this? Like, why are you doing that? And that never ended up being very successful because, and also, again, there's another problem with the sales compensation, right? Like the guys who are selling third-party product will never get as much comped as selling a first-party product. So that used to be a big problem in the resellers. So I'll just tell you the numbers, right? So think of it like when you're selling a in-house product, the COGS are almost zero, right? So you're getting the whole 100% value of the deal, right? And within that 100% value, you can distribute that value. But when you're doing a reseller, and some of these guys will say, oh, I'll give you 10% only. Then you cannot get anything done in that 10% because that guy, like think of it like here you're bringing in $100 to the company. There you're bringing in $10. And the effort is the same.
Right.
So this is the big problem that a lot of founders don't get it is why a large company cannot sell my product. It's this. So there used to be some firms like SAP and Oracle are like very notorious at that. They'll ask for 80%, 90% discount. Because then I think it becomes on par with selling the first party product. But then the founder says, oh, I'm not going to give you 80%, 90% discount, right? It's going to ruin my business, right? So that's a trade-off that you need to figure out. And in some cases, actually, 80, 90% discount is not bad. Like if you get a really good channel and you're not spending any go-to-market and you're just getting like free money from there, it's fine.
Right. And if that just becomes a complete part of somebody's strategy is relying on your CVC to be making, I don't know, like 30, 40% of your sales, and that's a bad way to
Exactly.
go to market. You probably want, you hope that that's just incremental revenue that's coming in. That's just, you forget about it.
Yeah.
Like if it comes in, it's great. Otherwise, you discount any of that revenue and work towards every other GTM strategy that you're thinking of as a
Exactly.
from a revenue building standpoint. And what about later stage? Like how does a CVC really help a later stage company?
So later stage, I think it has to be a very complementary technology strategy, because what happens is like anytime I brought a company that is like Series B, Series C stage, it's like it's too late. Why don't we just acquire? Like why are we investing in the company? Because it's already like like valued and everything, right? So Microsoft actually used to do a really good job with those large investments. So these are like really purely complementary strategy. Like for example, like Microsoft and Databricks, right? So Microsoft wanted access to Databricks to sell to their customers. They knew they were building something, but they knew they didn't have a product, and they just said, "Look, you'll be partners, and let's just invest. We'll get some information right. We'll get some upside." So Microsoft always did a really, really good job at the large investments. And like a couple of the investment they would do is they'd invest in like startups in India. Like they invested in Snapdeal and other companies to have them run their product on Azure, right? So it helps with business also. Yeah. So I'm a big actually believer in the later stage big money investments. So like again, going back to that job that I was interviewing it. So I said, our strategy should be twofold. Like one is on the early stage. Let's just focus on information, figuring out what to build, what's out there, like small checks, less than $5 million checks. But at the same time, let's just go use our dominant position. Like at VMware, we had a very dominant position, but we actually did not use it that well. We actually could have gotten like AppDynamics is a good company that we were evaluating, right? We could have put in $50 million in the company, and that would have netted us like 4x, 5x returns, right? But we never actually did that, but because people are just like, oh, why are we putting so much money? But Microsoft used to do that really, really well, because then you can actually have the cake and eat it too. Because first of all, the company is de-risked, right. And then you have a dominant position where they're actually begging you for money. So they wanted help from us, and we could have helped them. So for us, and they were just giving us everything that we wanted, like in terms of the terms and everything, right? Unfortunately, we didn't use that dominant position. I think if I were to do CVC, I would do both.
Right. And you also perhaps might look at a CVC investment in later stage and say that there is an opportunity to use this as an R&D testing bed. Like you talked about the Microsoft and Snapdeal example. Maybe a little bit more mature in that case, but say that investment was a few years earlier, it's a great opportunity to like see a scaling company in the e-commerce space use and leverage Microsoft's infrastructure to see if, how you can improve the product that Microsoft does.
Yeah, so we used to do a lot at VMware. So since we are a platform, and there were a lot of complementary services like backup and others that were developing on a platform. So investing very early and seeing them grow, and and a lot of times actually it used to dictate our R&D, like based on what we see from those partners. And
that's very interesting that you brought up that angle there as well. Now moving, to the other side. Now let's talk about from a startup perspective. I've taken money from a CVC, and these are the value adds that they bring to the table. How have you seen the best performing portfolio companies that you invested in leverage a CVC and work closely with them? Because I don't think it's just a straight up, hey, write an email, drop an email, and I'll say, hey, they become like an advocate, become a sponsor, become an endorser of what we're doing. It's a little bit more strategic from a point of view of building a long-term relationship with key stakeholders within an organization, and then using that relationship to actually, perhaps build a side of your business, help with GTM, help with revenue, and all that. So how have you seen some of the best best people?
Yeah, I'll start with the worst one right first, so I can realize. So the worst ones, they always start with business first.
Right.
They like, oh, we did an investment. Are you going a reseller? What is the process? Can you put me in front of the business unit and let's get that thing started? And they keep hounding me and everyone else, right? And then it doesn't become time. The large companies, they need time. It's like a dating time, because when you do an investment, it's like, think of it like a first date. Actually, a lot of people think that you're married at that investment, but it's a first date. So the best company, coming to the best companies, they always invest in actually people, right? So they get to know the investors. They make them their champions, right? So they will meet you on a regular basis. They'll ask you what's going on. So think of like an additional information source. Like I used to meet a lot of founders, and they'll ask me like, how's the business going, like from our angle, right? And I used to give them pretty good information on how the information, how the business is, how we are seeing the business, how things are changing, right? Then the second thing, I think the best founder they do is they create a personal relationship with the business unit, right? So with the GM and the CEO and everything, and they just keep it at that, and they keep on just staying in touch until there's a good time and everything lines up for a business relationship, right? They will not force it at all, right? They will have, and that's the best thing to do is like wait when there is a pull from the corporate side. So business relations is not something that you cannot be pushed, right? There were a bunch of guys who tried to push it, and then eventually it died because it was not very natural, right? So anytime there's a pull saying like, hey, this business is doing well, we should partner with them, and also when you develop a trust, the other person actually is willing to risk their career for you, right? So I would say it takes like a year to 2 years, but more or less I would say like, founders should think of CVC as, okay, instead of taking money from a tier 2, tier 3, filling my round, somebody who's not going to add any value at all. Like I took my money from a lead, gave me good valuation. I like the partner who's on the board. Instead of filling the round with some no-name VCs, I would still take it from a CVC because, something will come sometime.
As a result of that investment. Also, I mean, it's great validation from a market point of view if you have like a known investor putting in, especially a known CVC putting in capital. It kind of like indicates that they've probably done a little bit of their diligence and find some sort of strategic fit or financial return that they can expect from that investment.
Yeah.
Now, moving the conversation along, you've obviously spent a good chunk of years in CVC, and now you've been investing in early stage. What are the key personality changes that you've had to make as an investor who's had to flip that? Because obviously the tone, the investment lens that you take, the things that need to go into evaluating companies at a CVC is very different from early stage venture capital, where things are moving much more faster perhaps. And like you said, you might miss out on a couple of deals if you're not up to speed. How have you evolved as an investor on this side of the table?
Yeah, so one is there's the financial outlook, right? So we had to be successful on the CVC side, but on the institutional side, that's all it is, right? Like you need to invest in good companies. I think you need to have that financial angle. Is like, will this company become really good, right? So what happens is on the corporate side, sometimes you partner with someone with a company that has a good product, right? Good technology, you're partnering with them, but maybe they don't have a good go-to-market, right? So sometimes that's not a concern for you as a corporate. But on the institutional side, that actually becomes a number one because, someone needs to drive the business. So I would say like over the years, I have moved more from, does this company have a good product to does this company has a good JTM, right? Like moving from does this company have a good CTO and a good technology to does the CEO know how to sell? So it's becoming more and more important to like my boss here says all the time, is it's good to invest in companies where the products are being bought and not sold, right? So Yeah, so that's a very important thing that I look at. And the other thing is, I think the difference between CVC and institutional is also that you have to do your own diligence. On the institutional side, you are the one doing all the diligence. On the CVC side, you can actually bring in, like, that's one of the advantage of being on the CVC side is you can get the best people. Like, I'll give you an example. Like, I was investing in a company that was building like a database, like an edge database. So on theory, everything looked really, really good, and I did some diligence, and also looked really, really good. The founders were really good, and then I put them in front of some of this distinguished engineers and principal engineers, and they came back and said, "Don't invest." And I said, "Why?" Then they're like, "Oh, like in order to make this happen, you have to create a blockchain, and this company cannot create a blockchain." And I hated it at that time because I couldn't get the investment done. But fast forward, after 2-3 years, the company is not very successful. It's exactly for the same reason they couldn't pull this off, right? So anyway, going back to institutional side, you need to do your own diligence. For that, you need to again now create a network, right? You had that in a CVC. So a lot of firms, like including our firms, we have advisors, right? We have people who have operated like in finance, in marketing, in healthcare, and then you also need to have your own personal network that you go to asking for help, right? And that becomes very important. And one of the biggest challenge with institutional, what I've seen is like all that thing needs to be done before the investment comes in. Because after the investment comes in, you don't have the time, right? So that's been one of the most challenging part of this job is ever expanding the network in the new areas where I don't even know whether I'll make an investment, but someday that network actually comes useful to you.
Right. And that's one of the things that you and I were discussing that before the recording as well. It's important to build relationships in this industry, no matter you being a founder or an investor, because it's those incremental relationships that kind of like add so much value over time. It may not show immediate value. You may not be able to say, hey, a month from now, I'll probably do this. But 6 months from now, 8 months from now, when you kind of like need that person to vouch for you, if you've really harnessed those relationships well, you're able to call in a favor.
Yeah.
And some of the best decisions that have happened in my life have been through these relationship building exercises. And this podcast is actually a relationship building exercise for me. It's great that I also get so much knowledge and information and insights about company building and investing through the guests who have been on the show. But more importantly, it's the kind of networks that my guests have that really matter to me. I mean, very selfishly saying, but I think most people who run podcasts or most people who run any sort of an initiative are thinking about, hey, how best can you build a relationship with these people? And vice versa. You're obviously adding some value to the person as well. But in terms of harnessing those relationships from a founder perspective, and when you're sitting at the investor seat, how have you seen some of the best founders that you've worked with leverage you or the firms that you've been with really, really well? Because it's not as simple as saying, hey, Pramod, make an introduction, but it's about the nuances that go into them doing their research, trying to see if it's a good fit, qualifying some of these potential prospects, that from a customer perspective. But there's a lot more. There's investment where you can add value. There's marketing where you can add value. There's so many other ways that an investor can add value just outside of the fund perspective, but in their own individual capacity. How have you played that role for your portfolio companies?
Yeah, I think that's a very good question, actually. Like someday I just want to do a podcast just based on that topic, right? So when you're looking for an investor, a lot of times, people are looking for like a brand name, the valuation, right? And sometimes they're looking for like a domain expertise, right? So I think the best Uber a board member or an investor you can get is somebody who has the very deep domain expertise that can be useful for you, as well as a rational mind. And let me just come to that rational mind right away, right? So that is something very nuanced that a lot of people don't get. It is a lot of time founders, they think that, hey, he's an investor, read some papers, read some blogs, knows something about AI, wants to do an investment, what value he or she can bring. Or they will say, hey, I'm looking for investors that can make introduction, and they'll come and hammer you again and again. Give me customers, or I want to hire like a VP of sales, give me thing. I would say that is the worst use of investors, because I mean, like hiring is like, you should drive the hiring. Like if I have my network, if I can introduce you to someone, I'll introduce you, right? But telling me to run a recruiting process for you is not a good use of anybody's time, right? Same thing with customers. It's like I always say, right, look, all my time is dedicated to you. I go to conferences, I meet somebody, and if I think it's a fit for you, I will make an introduction. But if you want me to run your GTM and go and do business development for you, again, it's not a good use of my time. And again, me doing it versus you doing it is very different. Like me going to us like a chief data officer and saying, I have invested in this company, do you want to talk to him, versus you going and saying, hey, this is my company, this is my product, right? So in both the cases, if they have a network, they can introduce you, it's good. But you can see that and you can feel that, and that should be it. Beyond that, I think, like I said, if you want them to run hiring or something, it's not a good use. Right? But the other part I was mentioning about a rational mind, right? So a lot of my conversations with the founders is on very different topics, right? It's like, hey, we are doing a deal with so and so. This is what the contract looks like. What do you think about it, right? And that's where I think you see a good value of a good investor with a very rational mind. A good investors. I mean, again, it's a nuance because sometimes people use patterns, right? They say, hey, this has not worked in the past. This is not going to work and you should not do it, right? A good investor will say, hey, this has not worked in the past, but let's just think about it, right? So you need somebody to bring that historical whatever patterns, but not overload you saying this is the only way it can happen, right? But let's just think through it, right? And I'll see like day to day, week by week, month by month, as you're building your business. The funny thing is, a lot of times you need a partner to just think through some of this decisions. Like, hey, I'm hiring this guy. What do you think of it? This like think of them as like a sounding board, somebody who is curious, somebody who will like think on their feet and give you good advice. And I think that goes a long way compared to those 2 or 3 customer introductions. Like I'll give an example. Like one of the investments here, they were going back and saying, hey, customer introductions. I reached out, and like I said, I think it's much better for the founders to reach out. If I'm already connected with the guy, I can introduce you. But if I'm not connected and I have to go reach out, it doesn't work, right? And then after some time, they said, hey, we want to write a blog post about this. What do you think of it? And then we discussed it. I gave them a lot of good points on how to do it. And voila, I think they found like so much value out of it. Like they got so much marketing out of it. But they never thought about that, like we could actually help. I keep telling my founders, like, look, I'm 24/7 for you. Yeah. Feel free to discuss anything and everything. And a good person will say, I don't know this thing, or I can help you. Or at the end of the day, you have to make a decision, but I can give you my 2 cents.
Yeah, I think a good example of that was just last week when we had reached out to you and said, hey, would it be possible for us to, leverage you for some go-to-market stuff? And then you had some very good inputs in saying, this is probably going to work better than what you have in mind. And I think that kind of like just acing brainstorming kind of gives us an opportunity to like go back and think as a team as well. Like, hey, maybe this is a different perspective that Pramod's bringing to the table. Maybe we could try this out and see how that works out. And it's all about experimentation, especially at the early stage, and trying to see what kind of like works and what doesn't. Especially if, a certain path that you have taken in the past is probably gotten dry.
Yeah.
And you want to keep experimenting and seeing if there's other ways. So you bring up a very good point of leveraging investors to a good degree of brainstorming and not just saying, hey, can you just make a customer introduction?
Yeah.
So we're trying to get creative about how to do so. Now, having spent, the last, I would say 5 or 6 years investing in early stage, what are things that you look for primarily in founding teams that kind of like excite you outside of course, the TAM and all of that, but primarily when you're sitting down with founders? Because I distinctly remember, about a year and a half or almost 2 years ago now, when, you came and met with us, the intent was obviously to learn a little bit more about the business, but you also were really interested in learning more about us as a team.
Yeah.
And I think it's a good mix of team and the business that kind of became a focus. So we really enjoyed. And there's also one particular thing that you did that you and Shelly both did, which kind of like gave us like a good impression of, you're good people and we want to work with you, was every time you spoke, you said we, and not we as the firm, we as a team, like lean as well as the fun together. And he said we can do this, we can do that, we can. And for us, that was a great sign that hey, he's already putting himself in the shoes of our investor and thinking through this whole process. So for us, that became like a very interesting way of dealing with an investor, because previously we'd not heard anybody talk and think from that perspective. So it was a very new introduction for us from how a founder or how a VC was positioning themselves already into the future. So what's really important for you, perhaps when you're speaking with founders, and what kind of personality traits and what do you like to ideally see outside of just from a business metric standpoint?
Yeah, so it keeps on changing like every month, every quarter, right? As I learn and spend more time here. So now I'm putting a lot of focus on I see a lot of founders want to build a product, right? They're very passionate. They come from really good background. They want to build it, and they think that it will sell, or it's a company. Like a lot of times, people don't understand like the product is not a company. Like the company is, like I keep telling them, like you have to grow this to like 100 people, 200 people. And one time I said, you have to spend 10 years on this. And I actually scared away a founder from starting a company when I said that. And he literally didn't start a company when I said, you have to be ready to spend 10 years here. So I right now I'm putting a lot of focus on, the founders like really liking the space and the problem, right? Because that's what keeps them chugging along. I'm not a big fan of there are people like, hey, I want to start a company. Let me look around. Let me look at some problem areas to solve. Let me talk to some customers. I mean, you can still get some successful business out of it. But whenever you have some kind of a personal connection, or even to the extent that you spend more time on a particular area before starting a company, I think that's always important, right? I'm very wary of people who don't have that personal connection, or they have some weird connection, like, oh, my wife had this problem or whatever, right? So that is one thing, is like just being having some kind of a connection to the space. The second one I think is it's a bit nuanced, is, and this is not something, so most people think that, like you need to have a founder that is GTM focused, should be able to do sales. That is too long term, like Series A, Series B, Series C. You want somebody to able to grow the company, right? So they need to know all the go to market techniques. But on an early stage, like seed and A side, I feel like one of the founder should be willing to invest in growing the business, right? So the business is not just getting ARR or something. It's just putting the product in the hands of customers and having customers use it. And that becomes very important, because that actually drives a lot of the pivoting and experimentation, right? Like, hey, if I cannot find people who are using the product, let me pivot a bit, let me change the product a bit, or let me go in a different segment, right? I feel like that drives the success of the company, is having like a lot of founders are just happy building a product. Like they don't think that building the product is just like good mentally, but it doesn't help anybody, right? So I'm looking for someone who gets the pleasure of putting this in the hands of customers and having them use it and having some real usage out of it. And that eventually drives the go-to-market and the success, right? If you just build a good product and you feel like it will sell by itself, like it happens sometimes, but most of the time it doesn't happen, right? So those are the two things. Is like, one is I think just being close to the problem, liking and having some passion about it. And the second is I think wanting to make a difference, like, putting the product in the hand of customer and having people use it and driving the company through that, as like, hey, if I'm not finding any design partners, if I'm not finding customers, maybe I'm not doing the right thing, right? Mentally, I might be happy building a product, but if there are no customers, if I'm not able to even have people use it. Like one other thing that I keep telling, like one of the founder, and I really blew him, is like I said, give the product for free, right? And see if they have value. If they don't see value, even getting a free product, there's something wrong, right? And if you give it to 10 people and it's free and they start using it, then you're at a base level that, hey, there's some value. And then you can figure out how much they want to pay for it, right? So what you don't want is like, hey, I'm not going to talk to a customer unless he has a budget or 100K or something. I'm like, that's the wrong way to do GTM.
It's a very interesting point. Not a lot of founders actually think about it from that perspective. And even, going back to my investing days, a lot of them would obviously say things like, I'm going to sell to a customer that has a budget of, 100K to like 250K to like, for this particular product space. And, we'll kind of like take maybe 10%, or maybe not maybe 10%, maybe like 20, 30% of that budget. And we'll try and build our way to like a $1 million ARR. And that becomes such a short-term thinking because you're only thinking about getting to $1 million ARR number because you're only thinking about Series A. You're thinking about metrics that can like get you to the next round. You're not really thinking about, can I build a business out of this? Can I really put the product in the hands of customers, get more feedback? Maybe the product that you're even building is not what really gets you to an ARR number that you have in mind. Maybe you have to rip everything out and build something from scratch. But unless you put that in the hands of customers, you're not going to get that feedback from them. And getting it in the hands of customers is probably the hardest thing for anybody to do. Yep. And not everybody wants to do the whole free route, but that's just one way of getting it in the hands of customers. But like you said, if you can't, and if there's no pull, even after you give it for free, it's probably worth going back to the drawing board and rethinking what you have in mind there. You also talked about, when you were talking about one or two points about what you look for in founders today. The second point really stood out to me because what I wanted to ask you there was, can you teach somebody to put themselves in the shoes of a customer? Because it's not always about selling the product. It's not always about getting the product. It's about trying to get feedback, speak very closely with the customer base, trying to like understand where the pain points lie and try and uncover adjacent problems that customers actually face. Can that be taught to an entrepreneur?
I mean, that's where I feel like the value of a good board member comes in. Is encouraging you to do some of this experimentation and push you towards that. And again, that's a nuance between one investor versus another investor, and I'm not going to say which one is good or bad. Is someone just focus on too much, like, hey, what is your ARR? How many paying customers are there? Like, versus somebody just says, like I said, like this company, like I was not even an investor, I was helping him out, is like, okay, look, if you give the product for free for 5 people, how many of them use it, right? So I think that's where I feel like a good investor can coach you. Like one of my company that I invested last year, I'm doing that is just like, like one other thing that I was telling him is like, have conversation that don't lead to revenue. Right, so they're very, very much focused on selling what they have right now, and like, should I spend time talking to other customers? They might have them different requirements. I said, no. You need, like, every week you need to talk to someone that is not a customer today, but might be a customer next year. Right. I mean, he's doing it. I mean, like some of these are nuances. Like a board member, like I always focus on long term. And to me, long term is like, hey, if I give it for free, do you see some value? That's like my baseline, right? After that, it's like, are you investing in time with me? Are you giving me feedback of the product? That's another level of validation to me, right? And then afterwards, if you pay 100, 200K, I think to me, that's the last thing, right? So for me, engagement is very important, and having the right investors who can be patient and lead you through that. Like one other investment that in this company called Sardine, and he actually got this benefit from another customer. Another investor is, as he was looking for like a product market fit, there's one area that he did not want to go initially was crypto, and the investor said, maybe you should try it. It's a bull market, and as long as, so the good thing here is like, as long as it's the same technology, and you're using it for a different market, it's fine. You're not developing a different product for that market. So that actually turned out to be a very brilliant decision. Is like, hey, I'm not changing my product. I'm just going to a different segment, and it worked out.
It's just refocusing to a different or an adjacent market that kind of like sometimes helps. The other thing that we discuss here on the podcast with a lot of the investors is trying to understand how their best performing portfolio companies sell and go to market. You talked about Sardine. That's actually a good segue there, because in this case, you probably needed a founder to, one, be open to that feedback, two, go back to the team, have that discussion internally and say, hey, we're refocusing our efforts and trying to look at a different market. It really takes two different kind of people it's two different types of personalities within the same person. One, you have that ego within somebody saying, no, I think I know my space better than anybody else. And you need to have that intellectual honesty sometimes and say, yeah, you know what, we're open to it. That only happens either because you're truly intellectually honest, or you've literally thrown every dart possible at the board and nothing has stuck at that point of time. And you're like, you know what, this is just another dart. Let's try it. What's the harm?
Yeah.
So in your case, when you have seen people either trying to like reshift focuses, or they're trying to go after a particular market where they're also trying to explore adjacent markets and trying to figure out whether there is revenue that's going to come out of there, what have they from a personality standpoint done really well to understand and then sell to that market? And I'm not talking about just pure plug strategies that enterprise company, or sorry, that most startups used to like sell to enterprises. It's more personality changes that these founders have had to make to get into the shoes of selling to the to a larger customer, or maybe a new customer in a new segment.
I think understanding the customer's business is like really, really important. Like, so a lot of times, you find technical founders start something and they want to sell it, right? So as you scale, so this is a good example. Like Sardine is a very good example, right? I think like taking time and understanding your customer's business is very important, because that drives their decision making, right? So when this guy started selling to crypto, so the initial customers were like some of these exchanges that were coming up. They were seeing a lot of volume. They wanted a fraud protection thing, and that was very important for them to protect that, right? So just understanding that, again, what is the customer's business? Right? The customer's business is like transactions. And where do they make money? Where do they lose money, right? So they were making money from having more transactions, and they were losing money from fraud, right? So as long as you understand like where the firm makes money, where the firm loses money, or what's important for their bottom line, is very important, right? And you need to like the best founders, like the best CEOs, if you see, they actually become students of customers. Like if you look at the best salespeople, they spend a lot of time learning about you and your business and what's on top of your mind, right? I think understanding that is very, very important.
And in that process of like trying to understand the customer, a lot of people, in my experience, try to jump the gun. They're always, hey, they're not really trying to understand their customers. They're trying to just get to the pain point as quickly as possible because they feel that they can sell something to them. There's a nuanced way of getting to know your customer really well, because where I'm coming to is most times you may discover, especially early stage founders, that perhaps the product that you're selling is not where the pain point lies for the customer in and of itself. There could be a completely different thing that nobody is building for, or there's a bigger pain point that can be tackled. How do you measure against, or how do you basically get these founders, or your advice to these founders, to make sure that they're not skipping the gun and trying to really going after the sale, as opposed to trying to really understand the process and get really behind the persona of the person that they're speaking with?
It's very very hard actually. The this is so it's a combination of like I'll give you an example, right? So one particular vendor was trying to sell to VMware on a device backup solution, right? They kept on saying, "Hey, you have an old legacy solution. You should use a new solution, right?" And I mean, the guy was right. Like we were using a really old legacy solution and spending a lot of time understanding it, right? The funny thing is, in a few years, they ended up selling to VMware, but guess what? The use case was not that actually. So the use case was something very different, which is more to do with endpoint governance. And so initially they were trying to sell to the security team, but the second time around, they actually sold to the legal team. So the legal team said that we need to have this so we were actually sued. And when you are sued, you need to back up all of your endpoints. You need to do a legal hold and everything, right? So some of this nuances is like, what is the customer going through? But again, it's very, very hard. Like I would not say that, that the guy actually planned for it and everything, right? But I would say like three things you need to figure out is like, one is just macroeconomically what's going in a particular segment, right? Is the market up? Is the market down? Second is, again, on a company scale, like how is this company doing? Like, is it growing? It is not growing. Is there pressure on the bottom line? Is there pressure on the top line? Are they gathering more data, less data? Like also on the people side, like who have they hired and all of that, right? And the third one that it is a bit nuanced and difficult is to, and I think that's where some of the best founders do it, is to figure out everything around a particular area, right? So one of the founders that I know, so we acquired this company called Cloud Health, and my first podcast I did was with him. He's a big believer in actually. So he said you need to watch an area from a 10,000, 20,000 view and try to look for patterns and try to always zoom up. Don't even if you find a product market fit, don't just get married to it, right? Always zoom up, look at what else is happening around that particular space. So in this case, I would say like a predictable planned way of doing it is like asking like, hey, so you have this endpoint, like what all things do you need with it? You need security, you need governance, you might need backup, you might need legal hold, and go from there, right? But again, I would say this is a very unique use case. It's not something that you can predictably do, but I would say if you do all of that, eventually you're going to benefit more. Like a lot of times what happens is like you go to a company and say, hey, buy my product, right? And why are you not buying my product, right? Sometimes this and this actually is very important when you're selling to large enterprises. So the large enterprises will never buy because you have the right product. They'll always buy because they have a need.
So it really comes down to you spending more time with an enterprise customer and trying to see where the opportunities really lay. So I think that customer discovery becomes really important as opposed to even getting to make that sale.
Yeah.
Because you need to spend some time building that relationship. Again, going back to what we've been talking about on this episode, is building relationship with investors, building a relationship with customers, or even prospects, just getting to know whether they're even a good fit for you, for you to hold those discussions. Because otherwise, all the effort that you put in, this is again something that I've noticed, a lot of founders will put in a lot of effort with outbound without really pre-qualifying whether that's a good fit or not. It's just they think it's a numbers game. And then whatever somebody bites, you're like, oh, cool, let's go and have that conversation. Unfortunately, that's not how it works. It's much better for you to spend some time, qualifying whether these leads are even worth having a conversation with. Sometimes it may actually be scratching them off the list and saying, no, you're not a good fit. But learning more about how they're solving different pain points within their stack. And I can probably talk from a security perspective, is like trying to understand how different aspects of security are being addressed by the buyers that you perhaps want to be having a conversation with.
Yeah.
Right? Now, towards the last segment, we usually talk about something that's a little bit more like fun and try to understand a little bit more behind the persona behind the person who's sitting across the table from me. And if there's ever a person who's truly Desi on the show, I think it's you, because the few WhatsApp groups that we're on and all of the social media that primarily, I guess, on LinkedIn, where you've kind of like built this cult following and personality of somebody who's hilarious, somebody who's witty, somebody who uses a lot of Bollywood and India references to convey the thought, and most recently tagging with Nikesh Arora in some of your posts, and a little in jest. You've really built a good brand for yourself as an investor today. When a lot of people, like when I ask and talk to a lot of people about Pramod, the first thing that comes up, oh yeah, AI security and the funny guy. So it's really important to like differentiate yourself both from at any standpoint. Your brand and your persona is so important for people to remember. Was that something that you built intentionally? Because it's again something a lot of guests who come on the podcast are, after the recording, they usually ask me like, hey, I want to do a podcast myself. I want to do something. And my immediate response to that is figure out why you're doing what you're doing. You don't have, everybody does need to have a podcast. There's a reason why you probably want to do the podcast. And if it's for the fun, then get your founders on it, talk about, things that they build and give them more visibility or whatever it may be. Like figure out why and what you want to do with it. But with you, it kind of seems very organic. It seems like the person that you are. It kind of like ties into like things that you're interested in. How has that come about? How have you built your online persona this so well that today that people identify you from your social persona, especially when they even hear about you?
Yeah, I think somebody asked me this question. I think you're right. I think it needs to be organic. There's a bunch of people who have tried to do like podcasts, blog posts, even like memes, and then it doesn't go anywhere, right? I think my suggestion is I think find something that comes very naturally to you and go on that path and see if you can get success in that path. So what happens is like a lot of times people, they look at what's successful, like, somebody's doing a podcast, let me go do a podcast, right? So I've learned this very hard way, like learned this very late in my life is, like a lot of people say like, you should live your own life because, everybody's living their own life, right? So it's very important to find something that you're good at, something that is natural. And people like that, right? If people don't like that, then stop doing it, right? But it's worth trying, right? So coming back to like, so I've always been like a very voracious reader who can like really consume and synthesize things very fast. Like, so that has been like one of my qualities for a long time.
Where does that come from? Is it your childhood where?
No, I'm just like, I have FOMO. Like, so I always want to like be on top of everything. And part of it, I think, came from like when I was preparing for IIT, there's like no curriculum, right? Like you had to go and read up everything and consume everything, right? So even like 10, 15 years ago, when Facebook was like coming up, I used to share a lot of documents that I read like with a like button and it would come on Facebook and people would see that, right? So I would say like 15 years ago, probably all of that stuff was going to Facebook. About 10 years ago, I started using Twitter and I was sharing again on Twitter. On LinkedIn, I was not doing that because I think when I was at VMware, there was some sensitivity around like if I share something like, hey, is this me talking or is this VMware talking? And because I was in a corporate strategy role, I think people would take me seriously. And then I actually slowed down quite a bit during that time. And then when I joined the venture firm, I realized like there's no policing, like nobody cares, like so then I started doing on LinkedIn, and initially I started doing on LinkedIn. I think one other thing that helps is like you need to understand like so what, right? So a lot of people like they start sharing this document like, hey, NVIDIA did so and so, and that's it. I'm like why? It's good that you shared with me, but so one other thing that I try to do is just like people are busy, people sometimes can't click that link and do. If you've already read it, why don't you just do like a TLDR about it? And that has been something that people like a lot is like, hey, I don't want to read the whole article, just give me TLDR and give me something like a second grader will understand it, right? And I try to like simplify quite a bit so that, it's just easy to consume, right? So that's where on the LinkedIn side, and it also comes very naturally because I just read a lot of stuff around it and I can consume it, I can synthesize it. And then on the other stuff, I think that just accidental. So what happened is, so I used to do a lot of strategy deep dives when I was at VMware because we had to do it as a part of the role. And so when I moved on the venture firm, I was missing creating those industry views. And I started doing some of that on LinkedIn, but I figured like I don't have a following. I don't have, like, I'm not getting a lot of views. So then I started thinking like, what are some of the innovative ways to drive that engagement? And then I started doing some of this images and videos, and some of people like it. So
how important it is for somebody to like build a persona like that, because I don't know if you've quantified it in any sense and said previously these are the number of inbounds I used to get and now I get a lot more inbounds because of obviously 50,000 followers on LinkedIn. People kind of like obviously know who you are. Like it definitely drives certain
yes, I would say
perks.
Yeah, I would say like don't do it for that. Like so people keep saying that, hey, again, same question, like do you get a lot of, so I do get lot more inbounds now than before, right? I would say like
it's a side effect.
Long term, what I've seen is like I feel like it's very important for people to build like a act 2, act 3, right? Similar like a company, right? So what happens is like we grew up in India, like you study something, you take a role, and traditionally what used to happen is like you live or die by that role, and sometimes you retire in the same company, right? And you stop learning actually, and you stop developing any skills, right? Like right now when I talk to people early in their career, I keep telling them the importance of doing 2 or 3 things outside of your work. Like if you're just working all the time, that's not important, right? Do people, and I've realized that, so there's another nuance is like, a lot of times when you're working in a big brand or a good company, people know you because of that. Right. A lot of times people think that they like you, but they like the company, right? So it's very important to build that personal relationship. And I have learned that hard way after I came out of VMware, because when I was at VMware, people like talking to the company. I myself did a lot of work to build that personal relationship, but I realized that I should have done more. Right. So this is part of, I would say you need to do more on a personal level and not just do your job, right? So always connect with people. My manager at VMware always used to say that never eat alone, right? So he literally say that in a week you are on the campus, 50 day, like whatever, 200 days, 100 meals. Have you met 100 people during those meals, right? So he used to network like crazy. Like he would go and talk to, and we were just talking about how building network before the fact is important, right? So he used to go and reach out to a lot of different business unit and have lunches with them and all of that, right? Again, I don't think I did a very good job at that time, but I would say if I have to go back, I would focus on that personal relationship. And the second thing is developing something other than what you're doing, right? So like, when I started looking at AI, like we were not even doing AI. Like in my previous firm, I kept telling my team we should invest in AI. They're like, oh, it's a hype, it's a bubble, it will go away in 6 months, right? But I still kept on reading about it. So I would say like don't focus 100% of your time on work. I would say right now, if I were to tell someone early, I would say like spend 30% of your time on work, 30% of your time personally, like developing a relationship, and 30% doing something different and new.
That was actually going to be my last question to you. Like if there was a piece of advice that you'd have given yourself when you were starting out your career, would this still be the same thing that you would tell yourself?
Yeah, so I actually did it very, very wrong. So I actually went I was actually at a 300% actually. So when I started my career first 5 years when I was at Sun, so my manager changed, and when my new manager came, and he's like, literally, you're doing a work of 3 people. You're 300% working on your job. And eventually, actually, he found 2 more people to take some of my work. And still they were saying that you seem like overloaded, right? So I started at 300% and now I'm at 30%.
Right. Well, it's a great reminder for a lot of people that, I mean, it's not just about finding something else. It's good to have a hobby.
Yeah.
It's really important because I see a lot of people just burning out after a while, founders or people even in their regular careers. It's very important to have something that kind of like keeps them creatively stimulated in some way. It could be a sport, it could be like a hobby, it could just be like building trains for that matter. I know a lot of people who have the most weirdest, unique, and interesting hobbies that they spend so much of their time spending outside of work, which actually drives them because a lot of that creativity comes from trying to channel most of that. And most of them are like high achievers, so they really want to be good at something outside of like work as well. So they really put in that effort, attention, and all of that into some of the other stuff that they do. So it is important to have.
Yeah, the only feedback I would give on the hobby is like also I learned is like their hobbies and their hobbies, which means is like a lot of times you have some hobby and you claim as a hobby, but there is like 10x difference going deep in that hobby versus not. Like I'll give you an example, right? So one of my friend, like he's into singing, right? So there's a bunch of people who are into singing and they sing in their bathroom, they sing. But this guy took it to the next level where he actually does shows. Like he's teamed up with like a female singer. I feel like that's a really good thing to do is like just put your hobby into another gear, right? Or like there's another friend of mine, like he's into photography, and I have a hobby of photography, and I claim I have a hobby of photography. But when I met him, I realized like I was just like doing nothing because this guy actually like he has a hobby of photographing planes. So I would say like you go to an airport and you take photos, and that's hobby for me. But what this guy does is like he goes on a charter, like he will go on some of the fighter planes. He'll go and say, I want to photograph you. So he'll get a clearance and everything, and he'll actually go fly there and he'll take photos in the air. So now that's a hobby for me.
It's taking that level and taking it to one step, above what you're doing right now. That kind of like drives you. Even with your hobbies, you need that little bit of like, hey.
Yeah, so I'm actually putting a lot of focus on that. Like even with my kids and everything, I'm just like, look, if you're doing one thing, you have to just go all the way. Like 10 years, you're just doing that. You're not doing this for like 1 or 2 years, and you're just going to stick to that. So for me, I think, going deep on a hobby is so much important than just like on the surface.
Than doing like 10 things that you think it's really important for you to do that as well. I think that's a great note to end the episode on, Pramod. Thank you so much for being here and sharing some of the learnings that you've had from your time being an investor on the CVC side, on the traditional institution side, and some of the learnings that you've had working with some of the best performing portfolio company founders that you've had over the years as well. And little tidbits that you've been able to like drop along the way in terms of personality and how to build a brand in some sense, and trying to like find that thing that really motivates you outside of work. So this has been a great conversation. Thank you for being here, and hopefully we can bring you back in the future and we'll discuss a little bit more about all the things that you've learned between now and then, and maybe there's another bubble that we might be in a couple of years down the road that we can pick your brain on.
Yeah. Thanks for having me.
Well, if you've made it this far, first of all, thank you so much. It really means a lot to me and my team. We spend countless number of hours producing, editing, and pushing this content out, and it really means a lot to have your support. You could have spent the last hour watching TV, Netflix, going out and playing something, or on your phone, but you chose to spend it with us here on this channel, and that means a lot to us. We put on a lot of effort and will continue to do so. So if you do have any feedback, please leave that in the comment section. And while you're at it, hit the like and subscribe button so that you don't miss out on any of our future episode releases. I hope you took something valuable away from this episode, and we have a great lineup of guests over the course of the next few months. So please make sure that you tune back in again, and I will see you on the flip side.